The analysis and updating of accounts at the end of the period before the financial statements are prepared is called the adjusting process. The journal entries that bring the accounts up to date at the end of the accounting period are called adjusting entries. All adjusting entries affect at least one income statement account, which is either an expense or a revenue, and one balance sheet account, which is either an asset or a liability. The four basic types of accounts which require adjusting entries are as follows: prepaid expenses, unearned revenues, accrued revenues, and accrued expenses. Depreciation expenses are considered long-term prepaid expenses. However, they have different nature, so they are reported separately from other kinds of prepaid expenses. The first type of account which requires adjusting entries is prepaid expenses. Prepaid expenses are advance payments of future expenses and are recorded as assets when cash is paid. For example, November 30, XYZ company purchased office supplies amounting to 1,500 pesos. The journal entry to record the transaction will be a debit to supplies and credit to cash amounting to 1,500 pesos. And for example, on December 31, after the inventory count, the reported supplies in hand on hand is 1,000 pesos. So the 500 pesos is already used. The used portion of these supplies will be recorded as an expense. So the adjusting entry will be supplies expense is debited and supplies is credited, amounting to 500 pesos. The second type of account is called unearned revenues. Unearned revenues are advance receipt of future revenues and are recorded as liabilities when cash is received. For example, on December 1, XYZ received 1,800 pesos from a local retailer to rent land for 3 months. The journal entry to record the transaction will be debit cash and credit unearned revenue amounting to 1,800 pesos. And as of December 31, one-third of 1,800 pesos is already earned by XYZ. So the adjusting entry will be debit unearned revenue and credit rent revenue amounting to 600 pesos, which is 1,800 times one-third. The third type of account is accrued revenues. Accrued revenues are unrecorded revenues that have been earned and for which cash has yet to be received. For example, on December 15, Mr. Cruz and Malaya Tutorial Services agreed for a fixed fee of 1,500 pesos per session of tutorial for Mr. Cruz's daughter, payable every 15th of the month. Every month has 4 sessions, every 7th, 14th, 21st, and 28th of the month. To record the transaction on the part of Malaya Tutorial Services, the adjusting entry would be debit to accounts receivable and credit to fees earned, amounting to 3,000 pesos. Why 3,000 pesos? It is because on the 21st and 28th of December, Malaya Tutorial Services has already rendered tutorial services for Mr. Cruz's daughter. So for the 2 session, there is a payment on the part of Mr. Cruz, which is 1,500 pesos per session. So 1,500 plus 1,500 pesos is equal to 3,000 pesos, which is an accounts receivable on the part of Malaya Tutorial Services. So this 3,000 pesos is already earned on December. However, it is payable on the 15th of January, which is next month. The fourth type of account which requires adjusting entries is accrued expenses. Accrued expenses are unrecorded expenses that have been incurred and for which cash has yet to be received. For the sample transaction, XYZ pays weekly salaries of 12,500 on Friday for a 5-day week ending on that day. So for example, we have a calendar for December. For example, Monday, Tuesday, Wednesday, Thursday, Friday. For example, we have December 31 wrapping on Thursday. So there will be a 4 days for December. So these 4 day salaries is considered an expense on the part of XYZ. So the transaction to record or rather the entry to record the transaction will be salaries expense is debited and salaries payable is credited. But for how much? So on our example, 12,500 is paid weekly. So we only have 4 days, so we will allocate 12,500 to 4 days. So 12,500 over 5 days times 4 days. So the answer is 10,000 pesos. So the amount of 10,000 pesos will be the amount of salaries expense that have been incurred by XYZ but has to be paid in cash. So the 10,000 pesos is recognized as an expense by XYZ company at the end of December. The fifth type of account which requires adjusting entries is depreciation expense. Depreciation expense are derived from fixed assets. What are fixed assets? Fixed assets or plant assets are physical resources that are owned and used by a business and are permanent or have long life. Fixed assets and supplies are used by the company to generate revenue. However, there is no visible reduction in fixed assets unlike supplies. So, instead of visible reduction, depreciation occurs. Depreciation is the decrease in usefulness of a fixed asset. If there is a depreciation, hence the recording of depreciation expense. Depreciation expense is a portion of a fixed asset's cost. The adjusting entry to record depreciation expense is debit to depreciation expense and credit to accumulated depreciation. Why accumulated depreciation? It is because the original cost of a fixed asset and the depreciation since purchased are reported on the balance sheet. So we cannot decrease the amount of fixed asset. That is why we are using a different account or a new account, which is the accumulated depreciation, to record the amount of depreciation expense. So for example, an estimated amount of depreciation for the current year is 3,000 pesos. So we will record it. Depreciation expense is debited and accumulated depreciation is credited for 3,000 pesos.